The information provided by Nativities, aka me, is for informational purposes only and does not constitute financial advice. The disclaimer outlines the limitations of our financial stock advice and the risks associated with trading and investing. Before making any financial decisions, we strongly recommend consulting with a qualified financial advisor or conducting thorough research. Furthermore, there is no guarantee of accuracy. The information provided by Nativity is based on sources believed to be reliable, but we do not guarantee its accuracy, completeness, or suitability for any purposes. We strive to provide accurate and up-to-date information, but market conditions and financial news can change rapidly. Not financial advice. The content on our platform includes articles, analyses, and stock recommendations, is not intended to be financial advice. It is for informational purposes only. Users should not rely solely on this information when making financial decisions. Always seek the advice of qualified financial professionals before making any investment. Risk of loss. Investing in stocks and financial markets involves inherent risks. Past performance is not indicative of future results. Nativities is not responsible for any financial losses or damages incurred as a result of using our information. Users should be aware of the risk associated with trading and carefully consider their investment objectives and risk tolerance. Individual responsibility. Users are solely responsible for their investment decisions. Nativities does not provide personalized investment advice, and each individual's financial situation is unique. Users should consider their own financial position, risk tolerance, and investment goals before acting on information provided by Nativities. No endorsement or recommendation. Any mention of specific stocks, securities, or investment strategies on our platform does not constitute an endorsement or recommendation. Nativities is not affiliated with any companies mentioned and does not receive compensation for promoting specific stocks or securities. Market conditions. Financial markets are subject to various factors, including economic conditions, geopolitical events, and market sentiment. These factors can impact stock prices and market trends. Users should be aware of the dynamic nature of financial markets and the potential for rapid and unpredictable changes. By using Nativities services, users acknowledge and agree to the terms outlined in this disclaimer. Nativities is not liable for any direct or indirect damages arising from the use of our information. Users should exercise caution and conduct their own research before making any financial decisions.
Hello everyone, welcome back on a new video here on Nativities. I have a new portfolio update. I haven't uploaded in a while now, but I thought this was such a nice goal. I just wanted to post about it. So the goal that I've reached is the 50k euro goal. So for the people that have watched my last portfolio update, which is I think about 4 months ago, you can watch it if you want. I mean, it was a way smaller portfolio. I think it was about 36,000 USD or something like that. And 50k euros is about 54,000 US dollars, something like that. So the portfolio has grown quite a bit. So that's nice to see. And I thought this was such a remarkable achievement, or a remarkable milestone, that I wanted to let you guys know. Of course, the big milestone is 100,000. It's kind of the first big milestone that your portfolio has, right? Maybe apart from 10,000 or whatever. And after that, of course, $1 million. But that's $1 million is still a lot, many years, probably many decades away. So maybe I'll still upload some videos then and keep you guys updated. But the odds are unlikely in a couple decades. But hey, you never know how life goes. So maybe. But at least for now, the 50k euro goal has been reached. So my portfolio is made up out of mainly tech stocks with a wide moat that have an above average expected growth, and that is just by analyst expectations. And they also tend to have a healthy balance sheet. Now I also invest in Amazon, which has not that healthy of a balance sheet, not necessarily speaking that as good as, for example, Google or Meta, which are the two other stocks that I own. But it's still a good and healthy balance sheet, so I'm not too concerned about the large debt position that they have. The growth, they're mainly growth focused. I mean, pretty much all of them. I don't own any value stocks. I have owned some value stocks. That is Alibaba, but I've basically sold that position because it's a Chinese stock. I don't want to get into geopolitics too much, but there's just so much uncertainty regarding Chinese stocks and the Chinese economy and whatnot. So I'd rather just stay away from it and yeah, maybe in the future sometime I'll own some Chinese stocks, but I think it's unlikely I own specifically some Chinese stocks, even though I do own them in a different way, but we'll get that into that in the next slide. I do own as well some ETFs. Now the ETFs are not a big position in my portfolio. They're actually a new idea. It's because I'm 20 years old and I want to basically have a kind of little ETF position that I can use. So if my stocks don't perform that well, at least I'll have market rate returns. And that if in about 45 years I want to retire, I at least have some additional retirement savings, right? So that's basically the goal of my ETFs, is just to return me a market rate return and make it so that I can hopefully retire quite lavishly when I'm 60, 65 or 70 or whatever retirement age is at that time. Very likely 70 years old, by the way, or even older, but whatever, it's whatever. I invest about 2k euros per month, so I'm in quite a fortunate position. I have a decent job. I'm 20 years old, so I still live with my parents, and I also study at uni. So I live at home with my parents, which basically results in me having zero costs each month. I can basically invest every euro that I get. Now I don't do that. I still spend some time, some stuff on leisure and on whatnot. But basically, on the bottom line, I have about 2k euros extra each month to invest. Now, I'm very fortunate for that position that I have. I do realize that, and I do also realize that not everyone has that position, and not everyone is able to invest that much money each month. But if there's anything I can say about it, is that if you're young, especially if you're young and you can save costs, right? You can, for example, live a couple years with your parents or whatever. And I could, of course, understand that some people would want to live on their own, which is, yeah, it's just blatantly understandable. But for me, it's just saving those costs, and when you're young, investing those cost savings into an ETF or into stocks, and over the long term, that will really pay off because 2k euros invested right now will accumulate more capital gains over the next 45 years, basically until when I want to retire. And that money will be worth far more than at my retirement age than if I invest 2k euros every month at 30, for example, because of simply that compounding effect, right? So I think that's something very important that a lot of young people have to understand, that every euro you invest right now, or every dollar you invest right now, whatever currency you have, will be worth very likely, at least, far more in about 40 to 45 years. Of course, that's all expecting market rate returns of about, whatever, 8 to 10% a year. But overall, that is very likely going to be the case. So that was my little lecture about cost savings for young people. Let's get into the ETF now. So the ETFs I buy, and this is quite a weird mixture, I could understand. So I have Vanguard FTSE All World. I'm, by the way, European. Of course, I have euros, so I think it would be quite obvious to anyone. But for the people that haven't really gotten that yet, I am European. So I have some European ETFs, one of which is the Vanguard FTSE All World, which is an accumulating version, by the way. So it's famously known as the VWCE. It's about 40% of my ETF makeup. Then I have iShares Core MSCI Emerging Markets. I like to have a little bit of exposure to emerging markets because I believe All World has about, the Vanguard All World has about 10% emerging markets. And especially because I'm still young, I would like to have a little bit more exposure to these more risky markets that also potentially have, of course, a higher return. As an important detail to note with this is that I do understand that the FTSE All World and the MSCI have certain overlap. So, for example, the FTSE All World sees the Polish markets and the South Korean markets as developed, and the MSCI doesn't. So the MSCI in the emerging markets still has a large South Korean position. I think it's about 11% or something like that, and I think a minor Polish position or whatever. So I do understand that. I don't mind it too much. That's basically. So if anyone thinks that or wants to notify me about it, I already know. I already understand. It's just that I don't really mind. So here we also have the iShares S&P 500 Information Technology. I mean, come on, if you're young, you gotta have a large exposure to tech. There's no way you cannot do that. I mean, you can accept the risk because you have simply a lot of time still to go, and the returns that this ETF has had and the overall tech market has had is just phenomenal. I mean, I cannot let those gains just go away, right? I can't just leave them. I have to pick up some of those gains. So I do have a 20% position into an, IT ETF. Also, I do believe that tech is just going to continue to become even more important than it already is right now. So I think it's quite a logical position to take, or quite a logical ETF to buy. And then I also have some small cap to also get some extra gains if possible. Now, the world small cap has pretty much closely mirrored the all world ETF in terms of gains over the last 10 years, I believe, or so. So it's not that much different, but I would just like to get a little bit of small cap exposure. So then if we look at the sector breakdown, because of course you got to look at the overlap, right? We want to have the aggregated makeup of my ETF portfolio now. So if we aggregate it and we adjust it for the percentual makeup in my portfolio and whatnot, we get that I invest about 57%. And mind you, by the way, these percentages don't all add up. There are some rounding errors, which makes it that, for example, this could be 101% or whatever. There are just minor differences. Mind that, but I think it's just negligible, so I don't mind it too much. So I have about 57% in the US, 6% in China, 5% in Japan, 5% in India, 4% in Taiwan, 2.6% in UK. Well, you can pretty much just read all this. Basically, mostly still in the US. And I think that's, I actually like that a lot because the US is just by far, especially over the last 50 years, the far superior stock market compared to any other in the world. So I just like having a large US position, and in addition to that, like about 6% in China. I think that's okay. China is about the second largest economy in the world, and normally the VWCE, so that's the Vanguard All World, has just a minor position in China, like really tiny, like 2%, I believe, or something like that. I think that's ridiculous. It's the second largest economy in the world, so I'd like to have a larger position in China than just 2%. I think 6% is fine, also because you have to adjust for the risk. And of course, all these other economies, which are all fine. Geographical makeup is all right in my opinion. I think it's actually a little bit better than the normal VWCE makeup, normal Vanguard All World. So I like that. Now, sector, you can see really what that S&P 500 Information Technology ETF does to my portfolio, because now I have about a 40% position in tech. Do I mind that? No, I'm young. I like that actually. I like a little bit of extra risks to get a little bit of extra returns. So I very much like that. But this is where my portfolio differs an enormous amount from the normal Vanguard All World. Because the normal Vanguard All World is about 20% tech or something like that. So I think having a double exposure to tech is, in my opinion, completely justified considering my age. So then we go to the market cap makeup, and I have about 70 or 65% in large cap, about not 10% in mid cap, and about 25% in small cap. I like that. It's a good position. It's a good makeup in my opinion. It has a little bit more risk. The normal Vanguard overall has about 0% small cap, so I'd like to have a lot more small cap exposure. Also, the iShares MSCI small cap doesn't have an actual breakdown of its sectors. So since this is a small cap ETF, I assumed most of it would be in small cap, so I just put that at 100%. And so that's more like an assumption, but it should be around this anyways. So I think I'm quite happy with the makeup of this ETF portfolio. Then the idea behind ETFs is I invest about $300 a month, provided I'm 20 years old, so over 45 years when I'm 65 and probably want to retire, with an interest rate of about 6%, which is an extremely low assumption. I think the average return has been about 8 to 10%, so it's extremely low, but I would have about $800 in the future, which is something I think is a more than enough addition to my retirement, because mind you, this is besides my retirement contributions. This is besides my we have a government pension scheme here in the country that I live, so I also get some money from the government pension basically. So I think this is more than just more than enough to live a lavish lifestyle when I'm in retirement, and I think $300 a month is more than fine. So then the portfolio. I mean, this is kind of what we're all waiting for, right? So here we go. The portfolio. This is the makeup of my portfolio right now. This is the ticker symbol, the name, and here we have the amount of shares. My buy-in. So this is the capital that I've invested in it, and this is the current value of the position. Here you also see the average buy price of my investments. So you can see that all my investments currently are in the green. The ETF position is very small, simply because I bought them like last month. This was something I started doing last month. So here you go. Then of course I want to also supply some extra data. So here you go with my performance. My largest position by far is Alphabet. Recently, I've been more investing into Meta, simply because I think Alphabet is just way too expensive right now. I think the current stock price is about $185. My buy price is at $160, so I don't see it go down to $160 in the near future. So every time I get my salary, I invest it into Meta basically right now, because I think $500 or below is my buy price. The current stock price of Meta is $520, so I'm not buying it right now, but whenever it dips below $500, I buy. Amazon is also mad expensive right now. It's about $200, so every stock right now is just at an all-time high. It's so expensive. So yeah, I don't know what I'll do with my next paycheck if the prices are the same as they are right now, but we'll have to see. Also, we're gonna get the Q2 earnings report, so that might change some data. Maybe possibly some stock prices will drop, given that it is an irrational behavior of the market. I might buy some extra, or maybe we'll get some numbers that are actually phenomenal, and I could buy some stocks, because simply the projected cash flows are way higher than they used to be. So we'll see, but for now you can see my portfolio, where Alphabet is just in an enormous position. The same goes for Meta, and all these other positions are smaller, especially the ETFs positions. On Google, I'm up about 30% this year. That is, in a couple of months. I think I bought in about February, so in about 5 months, up 30%. Just phenomenal returns. That's just crazy. More based on luck, I must say, but I did do some research, and I did determine that it was way undervalued. So not to base it all just too much on luck. I do want to give myself a little bit of a pat on the back, but of course it's still luck is still a large component of this return. Meta is up about 10%, and Amazon's up about 18%. And the Amazon position is just pure blatant luck. I have to tell you that. I cannot say that was all thanks to my awesome analysis, of course. Now that's sarcasm there, but I bought Amazon after it rose thanks to the the fiscal year 23 report it was, I believe. The numbers looked very good. I was very positive, but I didn't do a very deep dive analysis. I had about 8K of cash, and I thought Amazon would be a good company to invest in, so I just invested some money. It's not this blatant luck, I have to admit that. But yeah, overall that investment decision paid off, and I'm up about 18% on that position, which is just phenomenal. Overall, this year has just been tremendous, even for all companies in the market. I mean, if you've lost money in this market right now, so basically this year, I don't know what you're doing, but get your game up, because the market's been phenomenal this year. The market's been phenomenal last year. I mean, the market's just phenomenal. It's unbelievable. But yeah, I do want to invest more into ETFs now, because I do also see that there are fewer and fewer opportunities, in my opinion. And I mean, Warren Buffett agrees with that. He has an enormous cash position right now. I do believe a little bit in that mean reversion theory, in where usually this is applied to asset pricing, but I also believe it in the sense of investor performance, where investors will tend to do really great one year and then continue to, will do a little bit worse the next year, and eventually you'll go back to the market rate returns. And eventually some investors will come out and they will have consistently better returns, like Warren Buffett and some asset managers. But I think overall the average investor will eventually hover around the market rate return. So yeah, if it's really worth all the time invested into to analyze stocks, that's it's doubtful, but I like to do it. For me, it's more like a hobby than really a job. So that's it. But I'm a strong believer in the mean reversion theory, that eventually every investor, or at least most investors, hover around the market rate return, given you invest for a long time and don't invest into stupidly volatile positions and whatnot. Now, of course, we can talk about the current value and the current portfolio, basically, but we also want to see what was my portfolio worth last year. Now, last year, or 1 year ago, I didn't invest in any stocks. So I didn't have this nice program here. I didn't have this nice overview here. I used a very advanced tool, a very complicated tool, to track my performance and to track my portfolio's value. And that tool is called Notes. Yeah, that's for real. I used to track it in like just a .txt file. So yeah, yeah, it's just it's insane. I understand. It's yeah, well, whatever. So basically, my portfolio was all into crypto. I didn't own any stocks. Okay, I was big into crypto last year. That would have paid off if I didn't sell, and I'll show you that in a second. But it's truly quite a humoristic story. For me, it's a bit painful, but it's quite. I think a lot of you will find it more rather funny. So I had about 18 or 19,000 US dollars, which at the time was about 15,000 euros. So you can understand my portfolio went crazy last year. I brought in about $20,000 or 20,000 euros of my own capital in that story, just so you understand the sheer returns that I have taken place last year. So I'm very, very fortunate, very happy with that. But basically, 1 year ago, I was all into crypto, mainly Chainlink. As you can see, I owned about 2,500 Chainlink. At the highest point last year, which was in, I think, June or July, I owned about 3,000 Chainlink, which at that time wasn't that much money. Right now, it would be a tremendous amount of money. I think right now it would be about 45. No, it would be, yeah, it would about 45,000. But I think about the highest point of the Chainlink saga, it would be worth at about $60,000 or whatever a couple of months ago. And I think even for a short while, if I kept invested, I did calculate it. If I kept investing and kept invested, I would have had at the highest point about $100,000. So it does hurt a little bit to see that, but you know, that's investing. Yeah, now I'll get to the funny part of this story, and that's in the red circle I sold. Yeah, I know it's yeah, I sold right before the enormous bull run of about a 4x. Yeah, that hurts. It is painful to look at, but I could understand that some of you might find it humoristic. Yeah, it's quite something. But I sold there, and I bought stocks instead. I bought Google. I bought whatever. I didn't. My money didn't stay idle. And to be honest, I would probably not go back to Chainlink right now, or any crypto for that matter, simply because now I understand cash flows and how investing with stocks work. And if you apply the stock investing principles to crypto, basically every crypto would be worthless. So I wouldn't go back to crypto right now. I just call myself lucky. I earned a lot of money with Chainlink. Okay, I traded Chainlink, not day trading, more like swing trading. And I think I 2x'd my money in a year just swing trading between the $6 and $8 range of Chainlink, because it hovered around that range for about a year. So I'd buy at about $6, then sell at $8, and it would basically repeat that process continuously. So Chainlink has served me very well, and I'm quite happy with those returns, of course. I mean, 2x in a year is crazy. And so yeah, it's not like I didn't earn any money with Chainlink. I didn't lose any money. Still did tremendously well, but yeah, of course I missed out on these tremendous gains, and yeah, that's quite something. That's absolutely, yeah. It pains me to see it a little bit. Portfolio as of 28th of June. Almost 50,000 euros. It's more than $50,000. So I just said, you know what, I'm gonna record a video and I'm gonna show you guys. So that's the portfolio right now. It's a year-to-date performance. So year-to-date, I'm up about 20%. Mind you, this is the part where I bought the majority of my Google position, and I bought Meta at about here or here, about this range, and Amazon I bought about, I think, here or something like that. So yeah, this portfolio has served me tremendously well in the last year, or last 6 months, I should actually say, 7 months almost. Thank you guys for watching. This was it. This was the portfolio update. And don't forget, if you like this, to like and subscribe. It does help me a lot. It doesn't cost you any effort nor any money. Well, maybe a little bit of effort, but if you like this video, then please like and possibly subscribe if you want to get updated about future uploads of my channel. And I'll see you guys hopefully in the next one. And thank you very much for watching again, and goodbye. Disclaimer: investing comes with the risk of losing all or part of your investment. I, the content creator, am not responsible for any financial losses caused by the information spread in this video or any of my other content. Every situation is unique, and therefore it is recommended for everyone to commit proper due diligence whenever conducting anything in the financial markets. Investing comes with the risk of losing your investment. I recommend reaching out to a licensed financial advisor for specific advice that suits your specific situation. Any actions taken based upon this video is done so at your own risk. I distance myself from anything you decide to do based on this video. See the description for more information.